Okay, hey guys, how you doing? Okay, so tonight we're gonna start talking about some obviously long-term important stuff. Um, there's been a lot of big shifts happening on the technical front on my end, but going into probably as of this week, I'm starting to move into looking at retirement, starting up this new trading account with Dukas Copy, so we can start working on all this over the next or talking about over the next couple of uh, hours or minutes or whatever. Okay, so the 4 points I wanted to go over, which are pretty important, is how many of you online on the chat mode, we got 6 of us, how many of you are right now kind of really worrying about retirement? Just give me a yes so I can have an idea. I want to make sure I'm addressing the right. Okay, so Isaac says yes. Anyone else? Just type up yes and then I'll know. Um, Okay, so Ron, yes. Indrajit, thank you. Sorry if I got your name wrong. All right, so let's talk about this stuff. It's very important. Um, I'm almost 50 myself, even though I look like I'm 12 or 15. I probably have a maturity of a 6-year-old, but that's okay. What I'm going to show you is typically what a lot of hedge fund guys are doing to segregate their trading account with their current day-to-day income. When it comes to trading, a lot of people think that they can basically trade and live off that trading account. A lot of people I talk to, even the 7-digit folks, don't recommend it. You have to have a separate revenue stream or cash flow stream, and then use the trading account to build up a retirement fund and live off that when you get closer to retirement. Does that make sense? Because the problem is once you start building up your retirement account, at the same time you're trying to live off it, you're not really going to take advantage of the next section here called the exponential power of interest. So even though you're going to build up a wealth account, you want to segregate 2 separate accounts and have different revenue streams for your day-to-day living. For me, like to live, say I live like a cockroach and just give me a couple of stamps and I can live off them, no problem. But my way I live is I live pretty minimalistic. I don't have a lot of big expenses. I don't have debts and that sort of thing. So I don't know your lifestyle. So if you have ways to build up a wealth account through trading and then put whatever your proceeds into that account and not touch it, and then have your day-to-day living account, you're good to go. All right, so as I said here, I'm sure how many of you, just give me a yes if you know about this exponential power of interest and the meaning of it, and where really it really comes into light with retirement. Just give me a yeah. Type up a yes in the chat, and then I'll pull up the article. Okay, so I'm going to pull up my chat here. Just give me a second here. Okay, I'm just going to pull up my browser here. Where is it? My problem is I have very limited real estate on this computer. The joys of laptops. Okay, so can you just let me know if you can see my browser? Okay, thanks, whoever. Okay, so I'm going to do just a search on exponential power of interest. And basically what it is in the world of commodity trading, it doesn't matter what type of trading, it's the profit you get from it. So what we're talking about is if you set a conservative daily move on the market of 1% of your entire portfolio or best, you're going to put your portfolio and capital at risk. And you're willing to put whatever that capital is, and you can get a 1% move off of that capital that you deploy and put at risk as part of your portfolio, and then you keep getting the upward momentum of 1%, you could pretty well build up a very nice account within a few years. I've had demos where if you have a 1% starting at $1,000, $2,000, you can build up an account into the 100,000 plus or even million plus if you keep on track of this 1% move on that target. And that's the key here about trading is you want to set a target a daily target of the amount of capital you're willing to put at risk. That makes sense? If anybody's got any questions, just ask in the chat box, and I'll gladly to address them. Because this is how a lot of the hedge fund guys do it, and this is how they become from nothing to literally billionaires in a very short time, because this is how they do it. And I don't want to get into the details of it, but if you want, I can put in this article in the chat box for you if you're interested. So the idea here is to get a 1% move every day of trading on your capital that you're willing to deploy and get that target, because once you get that profit, you put it back into the account, as I said here, in the I'm not sure what you'll be able to see here. I'm going to flip back to my so what we're talking about here is, as I said, the key 3 steps is to segregate a wealth fund account, or what would hopefully be a wealth fund account, and then have a separate cash stream that you live off of to meet your lifestyle. And again, that's something separate. But this is why we're talking about retirement, because retiring and trading at the same time is a big deal, because trying to trade and live off of trading can be pretty tough, especially if you don't achieve these 1% moves each day that you set as a target. And that's just a conservative. Some people may even try 2%. So again, we've talked about the power of interest. If you can get that 1% every day and then funnel it back right into the account, and then you can obviously, through no different than a savings account, you can build that account fairly quickly. So what's the likelihood of getting a 1% move every day? It depends on the kind of assets that you're going to trade. Obviously, stock trading may not give you 1%. Forex trading with leverage can give you 1%. And obviously, where I want to go down the line is to start trading options, because I've got guys in my groups that are bringing in, they'll put on, let's say, a couple $1,000, and they'll walk away with a 6-time, 5-time investment return on that position. And they do that every day, every week. This 1% move can grow real fast. Okay, so any questions so far? So I'm just giving you the high level of the retirement fund, and then we'll talk about algorithmic trading and automated trading, and some examples that I could show you just from today's news and maybe even Friday's news on some areas that you can use to get these 1% moves. Anybody got any questions so far? No? Okay, because I know it's a small group. All right, so the key here, as we've talked about, you don't want to dip into that account at all, because once you start doing that, you start to lose the power of that exponential power of interest. And you want to keep these 2 accounts separate, like your cash flow stream account, as well as your investment retirement accounts separate. And then you want to use that power of interest to exponentially build that account if you achieve these 1% moves. And that's pretty conservative, and it's not like unattainable. But when you start looking at the way I plan to do it with my automated trading systems that I'm building out, I don't see a reason why I shouldn't be able to achieve it, because I'm going to be universally looking at a variety of assets, including currencies or Forex, eventually futures and options, as well as some stock through ETFs. So the 1% moves are achievable. Anybody got any questions on that so far? If not, I'll move on to the next section. So what I'm going to do is I'm going to do another, pull up my browser here. Okay. So you guys can see my browser okay? I just want to make sure before I speak of this, I want to make sure you guys are not looking at a blank screen or my, shadowy eyes from staying up. Can you guys see my screen okay? Just give me a yes. Okay, and Indrajit, I'm sorry if that's your name. Thanks, Thanks, Isaac. Okay, so let's start talking about today's news. Okay, so this is my quant analytics membership. I'm not going to go on about what it looks like, but I do plan to leverage a lot of what I put in there. Um, I just put up two pieces in this membership, and what I do is I'll put up basically a piece of news, and there's two ways that I do it. There's the automated way, and then there's a human way, I guess you could say. So let me just show you some examples of what I mean. So what I'm going to show you is the latest news items. So just today, this morning, I've put in two separate news items. There's from Bloomberg this morning. There was some news about Australia and low wages and the Mexican peso. Okay, and then there's another story that or another report. This is the first one I'm putting into this membership that's generated from my up and coming system. I'm gonna have I'll adjust that in a minute. Let's just say. Okay, so from the human perspective, if you know that I do all my reading on Insta or on the Bloomberg News app. So what I do is every day I'm posting about 20 to 40 different news articles from Bloomberg, okay, from the news app, and then these get posted into my into my Instagram account, and these are just images of stuff happening in the markets, and these are global, all different types of asset classes like currency, stock, or whatever. Okay, so I'm using all this information I post every day and I have a little system that will gauge what has the likelihood of some kind of decent move for the next week or even the next day. So a lot of this I try to use as forward looking. I don't care about yesterday. I may not even care about today. I care about tomorrow because I want to set up my positions for tomorrow. Okay, so this is what came out this morning. So I post little videos on on just some news items. So typically, what I've got here is I've got two news items on the Australian economy. Now, obviously, here I'm in Canada, and right now our economy is kind of maybe a few weeks to months behind the performance of where Australia is because they're very similar. They're a commodity-based economy. They have two markets, two cities that have very hot real estate markets, Sydney and Melbourne, and they're now starting to hit some tough times because the commodities have slowed down. On top of that, the cities as well have these hot property markets, Sydney and Melbourne, and now they're starting to slow down. So what's been happening is in the news here, this is the central banker of can't remember the name of the bank here, Reserve Bank of Australia. What he's saying is that the real wage inflation, it's just not growing, but yet it's still getting more expensive to live in Australia. So that's a news item, and a lot of people say don't listen to news. Don't. I mean, that's all hogwash. You do want to listen to news, especially forward-looking data, because I can give you example after example on each and every day. There is a news item that will move the market, and that news event will drive the market. Friday was a good example where the market came off in the S&P 500, and that was due to the fact that housing starts were slow. So you get that kind of news event, and it really impacts the markets. And you get those day in, day out, every trading session. So I want you to be aware that this news is very important that you can use for trading purposes. And what we're trying to do is trying to catch the news items, the news headlines that will give you the widest pricing swings, either if you're going to short or long the market. When I say short or long the market, it's basically like saying buying the market or selling the market. So in this case, this is bad news with Australia. So in this case, this can be considered a shorting opportunity for Australia. Now, the question becomes, does that mean that the market will move at least 1%? And if it does, you've now potentially met your goal, depending upon how much capital you're willing to put to work for that trading session. So when you start looking for these sort of news events, you can meet these objectives. And this is just one item, okay, one trading item. And then there's another one that I listed as well on the Mexican peso. So if you're a forex trader, let me just see the news item here. Okay, so this again is the Australian news as I hinted. Let me just go back to my. Just looking for my last. Okay, so here we are. Okay, sorry about this. I'm a little scatterbrained these days. Must be my age. Okay, so what we've got here is I'm going to bring up that last posting. So we talked. Go ahead. Anybody have a question there? Here, let me just see. Okay, I'm not sure if anybody had a question at all. If you guys got questions or comments, just let me know and chime in. We're small groups, so if you want to do it by voice, we can definitely address it, or by chat, no problem. Okay, so going back to that news item that I mentioned about the Australian central bank. The other one that is important is Larry Sumner's. He was up for election to be the federal chairperson, chairwoman of the central bank of Fed Reserve. He was number two. He was considered as number two behind Janet Yellen for to be the Federal Reserve chairman. And he had some interesting items that he said recently on the last day or so about the same thing as what this Australian central bank mentioned about the rates being too low. The interest rates are going to kill off a lot of households, and I'm going to address that in a minute and show you some reports that we can use to better track that. Okay, so I'm going to put some of these links here that I'm mentioning here. So this is the one from Larry Sumner's, and I am going to get that one for the central bank guy as well from Australia. Okay, so these are two important news events for the day, or what could have been. I mean, there's a lot of other news events, Amazon taking over Whole Foods and all that. But these are the kind of predictable news events that can happen the next day, and they've been working pretty good. I've had some good forecasts. The Brazilian real, as an example, a few weeks ago, I put an alert through this service about shorting tech stocks about a week ago, a week ahead of when a lot of the tech companies on Friday dropped, and we were about a week ahead. So I started setting up some short positions to take advantage of that, and I did pretty good. So it's using this methodology has been working pretty nice, and obviously I'll be scaling this out and automating it. And as I said, these are the things that you're going to want to look for, these 1%, at least 1% moves, and try to have some predictability and consistency behind it. So these are just two examples of news events. Okay, so the other one, as I was mentioning, was the Mexico peso. So this is another important one because when Donald Trump was going to become president, he was talking about building the wall, and then the peso dropped, and the Mexican stock indices went down because of that. It was just negative news against Mexico. But over time, the Mexico peso has been coming back. And over the last couple of weeks, the Mexican peso has been one of the best performing currencies out there in the world. So if you knew about watching these kind of news events, you could have done very well with the peso, like using the peso and US dollar pair because of these political news events. And as a result, there's also been some news events coming out of Mexico about risk within the Mexican economy because of NAFTA. And obviously professionals are going to be looking at the risk of Mexico. And because it was fairly risky, it's come off, and now all of a sudden the peso rallies because of it. So once again, once we start looking for these news events in the world of currencies or forex trading, you can somewhat use it as a forward moving indicator to say, I want to put a call on the Mexico peso with the US dollar. And you can get a move and predict that move and hopefully get that 1% move that you want. And if you know how to use leverage within your Forex trading, you can do quite well. But just another example, I'll put this article in the chat box as well. So does anybody have any questions thus far? Now, as you know, I'm not here to blab about myself and see myself on camera and like to hear myself talk. This is about you guys and learning and contributing. So any of you have any questions so far? Because what I'll do is I'm going to show you the second posting that I put up earlier this morning. If not, I can move on. And this is the central bank report that my system now generates. Okay, so if there's no questions, I'll gladly move on. Okay, so I've talked about the news items of the Australian low wage issue, as well as a Mexico peso that's going to drop. Okay, so remember that this posting is generated by me by digging deep into these stories and looking for these articles to verify these stories. So now I promised to be starting this about a month ago to automate my trading and the reporting. So this is the very first one I've got in this membership. So this new one I just put up is very critical. I'm going to do a deep dive into this. I'll probably do a more up-to-date one in 2 weeks. So 2 Mondays from now, we'll do this as a topic separately. But I just want to give you a highlight of some of the things that you can use to gauge a whole pile of stuff. So in here, this is again system generated. So it's got a little report, and I'm just going to download the article. Actually, so I've already downloaded it, obviously. So let me just look for it. Okay. Just going to navigate to it. Just give me a second here. Okay, so what I'm going to show you is the same report that you can download. This one right here, it's called Fed Reserve. It's a Word document. And basically what it is, it's a snapshot of the Federal Reserve. Okay, this is a critical one. Again, this is all forward-looking, and I only use forward-looking data. A lot of people ask about technical analysis and fundamental data. This is all econometric data, meaning it's from economic. It's data that's gonna that's part of the U.S. economy. Okay, and a lot of this data is from the Fed. So the sources I get this from are from the Federal Reserve. I don't know if everybody knows about this, but actually, can you guys see my Word document? Oh, hang on here. I just got a question from Ron. Hang on, Ron. I'm just going to load up a new share. Let me know if you guys can see this report. It's called the Federal Reserve Snapshot. Just give me a yes on it, and I'll answer Ron's question. Can you guys see my Federal Reserve Snapshot Word document? Just give me a yes if you can. And then I'll get on about that. Okay, thanks, Isaac. Okay, are you gathering any backtesting stats to realize the hit ratio impact of news based on index? Okay, Ron, when you're referring to index, are you referring to like a stock index, like an S&P 500 or an ETF like SPY or whatnot? Just give me a yes on that and I can address it. Because this may answer your question actually. So if you don't mind, Ron, just answering that question, if you're referring to like ETFs and the S&P 500 as you said in the question index. Okay, in the meantime, let's talk about this Federal Reserve snapshot. Okay, so this report is generated by a Python script, and as I said, it downloads from Fred, which is at the stlouis.org. stlouis.org website, and this is basically the data part or the data that you can download from the U.S. Federal Reserve, and this is all forward moving. This is all important within the. This is the exact information that the Fed uses to gauge the to gauge the federal calls on interest rate hikes. Isaac, yes, this is let's address that later. Isaac, I just want to address show the report here. Okay, so Ron says take year Mexican FX rate example. Did you track, let's say, 50 news articles which indicate to you that such news are leading to FX buy trading signals? Um, yeah, I know what you're saying, Ron. Okay, so there's different ways to trade the markets. You could trade the currency futures, or you can trade a forex trading account through a trading pair through a retail trading account. I'm referring to a retail trading account, like with Interactive Brokers or Duca's Copy or FXCM, one of the big FX trading brokers. So, with that, you can use these news events as part of a way to gauge movements between two pairs, between, let's say, the US dollar and the Mexican peso. Now, the FX rate, I'm assuming, if not sure if you're referring to the futures contracts. If you want to narrow that down, I'll try to address it. But I'm just saying that with these type of news events, these actually will affect future contracts as well, and it will obviously directly impact forex pairs as well. But I'm going to show you some of the stuff that has impacted the U.S. dollar as well. You're referring to spot. I would imagine so, because when you're looking at a spot coming at a central exchange, obviously that's where like the big players are going to be to do a lot of trading, which will impact spot rates on the FX and or on the FX rates for the U.S. and let's say the Mexican peso, if that makes sense. But let me just get through this report and we'll talk about the impact on currencies, and we'll just use the U.S. dollar as an example. Okay, so as I said, this is the Federal Reserve snapshot, and I've already done a video on this, so I'll just do this at a very high level, and I'll do this more drilled down. I'll drill it down and do some analysis with you in 2 weeks because this will change. But the keys here is for what Ron's talking about let me just see where it was. So he's referring to news articles. What we're doing here is we're actually looking at the Fed data that the Fed is using historically. So in this case, you can see it goes all the way back to the 1920s. And I'll show you some classical business cycles that are used. Do you guys see? Hang on here. Can you guys see my screen? This is the Federal Reserve snapshot. You guys should see it because I don't want to make sure I'm not talking to. Okay, so you guys can't see it. Hang on here. That's weird. Can you see it now? Hang on here. Let me just pull it up. Okay, something's going on here. LDCM. Oh, okay, I'm sorry. My fault. I've been a bad boy. Okay, can you guys see it now? Just give me a yes if you can see what I'm talking about. Okay, now we know what we're talking about. I see that type says yes. So if you can see this, the Federal Reserve snapshot. Okay, so let me restart. Okay, so this is a typical chart, and there's 5 different, I can't remember how many charts there is, about 10 or 12. And these are a snapshot of the U.S. economy, again, using forward-looking data, downloaded raw data from either Quandl or for the Federal Reserve. Okay, again, as I said, on the stlouisfed.org. But this is the data that I download, I store as a CSV file, and then I plot a chart from it. So what I want to highlight here, and as I said, I've got a video on this that I just posted today. Each of these reports are either reported in frequencies either by quarter, 3 months, or by month, or by week. So in each report, I make sure I state what the periods are. Okay, that's very important. So what we do here is we do a 1 month analysis, an average of the 1 month, or in this case, this would be the latest data point. And this data point that I'm referring to is the percent move for the month. Okay, so you can see here you have a 1 month move on this industrial production mining. So what that means is if you started putting in, let's say, um, a position on for the month, you would have gotten maybe a 1.5% move for the month, roughly, if an ETF that focuses on, let's say, production mining, which obviously probably would include most likely coal, because that's the largest commodity coming out of the US, right? Okay, so what I've done here is I've set this up as a 1 month move, so that's the latest data point. And then we have 3 month, and that's the average of the last 3 months. And then I also do the 6 month analysis and a 12 month. And these are, again, their average percentage moves. Okay, so I also want to measure the momentum of the chart. So what I've done is typically what's used is just simple number of positives and number of negatives. And this is measured over the last 3 months. So in this case, what we have is it's moving up, but there is a negative, which means it's somewhat choppy. Okay. So you can sort of see that in the report. Now, I can make this data available to whoever wants access to it through my membership. I just learned through history that people easily get overwhelmed by this stuff, and I try to just keep it condensed in the equivalent of an executive summary. So you can get the data, I can provide the charts, and you can get the exact um, chart, and I can even break it down further by going at a more granular level instead of just plotting since 1920. I can actually just plot the last 10 years, and you'll get a better representation in the chart. But what I want to show in these type of charts is the historical view of these charts since the Fed has been tracking it. So in this case, it's since 1920, and you'll see why I'm doing this in a little minute. In a minute. So the next chart where we're looking at is the GDP, the gross domestic product, and obviously it's going to continue up. But there's also the real GDP, which I may include in this chart. But for now, I just include the gross domestic product. And here again, I'm doing the same thing. These are the percent moves, and then the 4 quarters, and then the number of positives versus negative movements. So in this case, we got 4 positive, which means it's a 100% momentum up. So that tells you right there the GDP is going up, which is a good thing, obviously, and that's good for the U.S. economy. So this is reported on a 90-day period, but the problem with this is it doesn't reflect the true. Let's say in 30 days, you're not going to see if there's any negative moves. You will not see that data until 30 days out. So this is kind of okay to use, but it's just really used as confirmation. So again, this is all forward-looking. Now, this is a really good report in itself, because what this means is that you have the industrial production index. And what this means is that, again, same thing. We have a very small negative move in the last month. And basically, we have these three movement, 3 months, 6 months, and 12 month. And I get doing the same thing where I have the momentum of how many positives versus negatives. Okay. And then again, this is every 30 days. Okay. So that's generally how I'm doing this, to keep it very simple. But the idea here is to say to you, the person that's reading this, is that industrial production index is not a very strong sector to deploy capital in. It's flat. It's not. There's not a lot of growth here, because you're seeing that you're getting a combination of 2 positive movements in the last 3 months and a negative one. So you may get a negative one next month out. So if you're going to deploy capital and you want to get those maximum upward moves or downward moves, if you're going to short the market, you don't want to be in this type of sector. Okay, just as an example. And that's to get your optimal or maximum returns when you're deploying capital. Okay, so this is another important one. I'm sure you've heard of it, the University of Michigan Consumer Sentiment. This is important because this tells how the U.S. consumer feels about themselves or the household. If they're not confident, they're not going to spend money. So in this case, you can see, once again, last month was a very small positive movement, so it's slowing down. And again, you can see a 3-month average where it's slightly negative. They're shaky. They're not feeling too good, the consumer in the U.S. So 6-month, it's not so strong. You are getting some 3-month positive movements on the consumer sentiment, which is good. But when you look at this type of data on how slow that movement is, that's showing that it is slowing down. And this is just another confirmation that you can use to say the U.S. consumer does not feel good about the future. So they're not going to spend money if they don't feel good. The reasons they may not feel good is they may not feel too good about their jobs. So if they're holding back on their spending, that means there's not going to be a lot of growth. Now, that can tell you a lot of things. You can say, well, maybe stocks isn't the best place to be because, if you're going to be in, let's say, consumer discretionary sectors on a stock front, that might not be a place you may want to be for maximum return. So as a result, you may want to look into other asset classes, be it, as I said, commodities or futures options or even Forex. Okay, so that's why we're doing this type of analysis for the U.S. Anybody got any questions so far? If not, I can keep going on about these, and I'm going to show you each and every one of these. So this is a classic business cycle report. Correlations. Again, Isaac, I'm providing the raw data. Okay, so what you would do, actually, there is some correlation data we can talk about. And a good example is when you have the GDP. There's some newer reports that I'm seeing that the Fed has, like for example, consumer household debt to correlate to GDP. Okay, so that's a correlation there, or consumer profit as well, or consumer debt, corporate debt or corporate profit, and you can measure that against GDP and correlate it that way. So there's different ways to go about using that type of data as additional ways to forecast the moves, and the Fed has that kind of data. I've just started noticing in the last 2 weeks, so you can correlate using that. And other things that you can use as well to correlate one against the others is the Treasury. A good example is if you want to correlate the US dollar against the US Treasury or 2-year, 5-year note, there is some good, decent correlation between the two of the US dollar as well as the Treasury as well. And they're using this data to measure what the Fed's going to do. This is very important stuff. That's why we're analyzing it. But back to the building permits, which is really important as well, because now as a lot of manufacturing has been outsourced out of the US, construction is a big sector in the U.S. economy. And this is a great example where you can basically see the historical crashes built around this. And these are early indicators that you can use. And again, you can download the data yourself and look at the actual numbers. What I'm doing is I'm just looking at some averages and looking at some momentum moves and giving a pretty decent picture of the whole historical moves on these type of data points. So in this case, we're looking at the private housing units, which again is really important. So you can see here, it's up and down, but there's always a crash just before the market crashes, when the housing market or the housing restarts slow down or even collapse like it did in 2007 and 8. And these are early warning indicators on the US economy on where the market's going to go. So this is another great example that you can use as a shorting opportunity to maybe short some, not ETFs, but building developers. A good one would be luxury home developers like Toll Brothers, and short. This is a screaming give me about housing. And not only that, but this also affects real estate as well, like real estate investment trusts, because if this is going to go down, it's going to affect other markets as well, like England or Canada as well. Okay, so I just wanted to hint that, and you can see the historical here, and this is really important to understand this, where people say, well, you can ride the markets and you can ride the business cycles and trade like that. Yes, you can. But when you look at the low points, you don't know the low points exactly when they're going to be. But there's data that you can use to confirm your theories on when you're going to make those low point calls. That's problem one. Problem number two is when you look at the magnitude of the upswing on the next up cycle in the business cycle, you can clearly see is like here in 19, let's say 70 to 72, let's say, that's a pretty strong upward swing. But again, when you compare it to uh, late 80s to I'm going to assume 2006, 2007. It's a totally different type of upswing. So you cannot really properly forecast these kind of swings from an economic standpoint. But you can use other data points that I'm showing you here. And that's why you want to use the forward-looking data. Okay, so here again, we can see some negativity as well in the housing starts. So again, things are starting to look not too good for the U.S. housing market. Okay, and the 6 month as well, long term is not doing too well because it's slightly going negative. And even the 12 month. Okay, so you can see here there's more negative than positive. Not a good sign, right? See, here's a non-durable, new order durable goods. Durable meaning hard product. The big sectors obviously would be auto manufacturing and plane manufacturing, like Boeing. These are the big companies in the U.S. that can move these kind of indices, not the little guys. So again, when you look at it, you get the classical business cycles, as well as you can see it's gone negative, slightly 3 month, barely positive, and 6 month average. So overall, you can get an idea of where to look on what sectors to maximize your trading opportunity if you're going to play in the stock market or the ETF world, and zero in on what parts of the U.S. economy you want to play in to get maximum return, if that makes sense. And we'll come back to it, and I'll show you the ones that look good. So we're using this kind of data to forecast movements in the market, and you can also somewhat get an idea of when the top hits on that upswing on the markets, and it's going to come down. But the hard part is when it goes choppy and it starts to flatline, you don't know when it's going to come down. But using a combination of these data points, you can get all kinds of confirmations, and this report is a good example of using that. So again, we're looking at non-defense capital goods. So this is not including aircraft or military expenditure, because typically in a recession, you're going to have the military. The defense is going to be the only area of growth in terms of manufacturing for, wait till Trump builds up his armaments. There'll be some growth in the military as well, as he's already increased. The only thing he increased in the U.S. budget was the military. So there's going to be some expansion in defense manufacturing or military manufacturing, and you can clearly see it. It's somewhat flatlining, but it's not negative. Okay, it's a little bit of growth there, but it's much better than having no negative growth. So again, you can see it's all positive for the last 3 months. So that's a good one to put money into to get maximum return. Another one, payroll. Again, this is non-farm payroll. It's a popular one. It's going up. We expect that. You're only going to get negative when there's some major shock where there's major contraction, and that would be like in 2008. So here we have unemployment. You can see here historically, this is a nice chart because it will hint at what points unemployment hit. And see here, these are the typical cycles. When we hit low points, here, 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 and here, and here, and this goes all the way back to 1948, since World War II, we are due for some kind of contraction in the U.S. market, which will spike again unemployment. Historically, we see it here, and we're hitting those low points. There's definitely the low point in unemployment, as well as the topping of the U.S. markets as well, like the S&P 500 is hitting top. We're hitting records now, so it's going to come off, and you're seeing the charts now show that there is negative growth coming, or not negative growth, declining growth. Well, no growth at all, I should say. So it's negative, obviously, so that means that the unemployment's falling, which is a good thing, but it will go back up when you historically look at these charts. Okay. So this is production manufacturing, another one. Again, I'm not going to go on about this. I mean, this is pretty self-evident on the idea. But you can see here there's some negative growth again in manufacturing, but this previous one here is a nice one. As I said, where is it? Yeah, manufacturing, new order, non-defense, excluding aircraft. Okay, so let me just, so we have industrial, and then we have the durable consumers goods. So because we've already talked about consumer sentiment and it's looking not so confident, maybe actually in decline, this will get hit as well. So you can see already, it's already gone negative the last month, the last 3 months it's gone negative because you have 2 negative months out of 3. So that's confirmation on the consumer sentiment. So again, this is not an area you want to invest into. Production business is only purely business related, nothing to do with the consumer. Again, same thing, 2 negative months out of the last 3 months. So again, that's just slowing down on that momentum. Production material, uh, so we got some positive here. So again, materials is not doing too bad, positives, and that's forward looking. So this is another area of growth to look into. Um, and continue uninsured claims, no different than the unemployment. And I think that's pretty well it. So you can see some areas of growth to maximize your opportunities just alone in the stock market for the US. And there's a whole pile of other trading opportunities that can come out of this knowing this kind of information. We could talk about commodities trading, dig into what metals or what industrial commodities would be used for the growth areas that we've just highlighted here, and the companies are impacted by it. That could be, let's say oil was going up. Okay, that's going to impact obviously refiners, obviously going to impact oil producers, and there's a whole variety of industries there that you can invest into to get maximum return, to get those 1% moves. So these are just small examples that you can use, among other things, as Isaac asked about in terms of correlation. And the two ones that I've talked about before was household debt to GDP of a country, as well as corporate profit to GDP as well, if that makes sense. Okay, so I'll do some questions because we're just coming up to an hour here. And if we don't have questions, we'll just wrap it up and leave it at that. But I just want to tell you about these kind of calls that you can use to get maximum return on forecasts for moving out into the future. And now that we're moving into a choppy market and which may go negative, we've now seen two areas that look pretty good to invest into or trade into over the next month or two. Okay, and then we haven't talked about, I haven't mentioned, we're just doing the analysis here for the US, okay? Because the US over the last 6 months has had underperformed compared to other countries. If you looked at Thailand, has been very strong in semiconductors. So that if you knew that through the Bloomberg news, you could have done very well in that sector in Thailand. Japan has been doing well as a index, as a topics or a Nikkei. You could have done well there if you knew about it. You could also put money into the DAX, the German index as well. If you knew about it, how do you know about it? That's where the news from Bloomberg comes in. And knowing these kind of moves can give you opportunity for 1% moves, as I hinted in my document. Let me just go back to it. Okay, so, hang on here. Boy, this isn't working for me too well. Okay, can you guys see my document that I mentioned? Okay, so let's recap here. All right, so we talked about segregating out your retirement account only. If you want to get wealth and using the power of interest from that, and you compound it with interest, as in the next point, you can easily build wealth with that account, but just not dip into it and live off it, because once you start dipping into it, it loses that power effect. So it's really critical to try to find other, basic cash flow streams to get by on, and that's really important when you want to build up a wealthy retirement fund as we get older. And as I said, I've got people that have built up accounts from like a few $1,000s to a couple hundred grand in a few years because of the power of exponential growth, compounded interest. That's what I should say, compounded interest. And again, one thing I want you to realize is always make sure that you target every day you do in trading with automation, which you can do. You want to get those 1% moves, because when you get those 1% moves, and actually if you can even increase it by, let's say, 2%, you're compounding that level of interest in that trading account even further. So you can increase it, and usually the markets can move from 0.25% to 1% every day, shorting or longing, buying or selling. Okay, and then the other big thing is don't dip into that trading account at all if you're planning to retire. So if you can find something else to get by on, selling hot dogs in the street, I don't know, but cleaning toilets or something, I don't know, but it's really important to build up your account. And I'm going to tell you something as well. It's really important that you understand that I'm seeing actually a good example. We've already talked about it with what's happening in Australia. Where is that article? That one article that we talked about, the future of what's happening in Australia. And it's going to be reflected right throughout the West in a lot of countries. I'm just looking. There we go. So this article, this one right here from The Guardian. Yeah, so this is a classic example of what's happening over time, is that people are not getting the wealth effect because jobs aren't paying as well. Like here in Ontario, I've heard the stat of, I'm sorry. Sorry, Isaac, thanks for keeping me in check there. Hang on here. Let me get Chrome. Okay, let me know if you see that now. Do you guys see that? This is the chart we went back to. Okay, cool. So that comes back to what I was talking about earlier about the job growth. There isn't any. There's no interest to be made in banks anymore. I'm going to be honest with you. I've seen some reports last week on the Bloomberg where it said 50% of all wealth in the world will be controlled by the 1%. Think about it. 1% by 2021, 50% of the global wealth throughout the world will be controlled by the top 1%. And a lot of their investment comes through trading. And it's exactly through things like this, where they have a good investor that is always looking for maximum return. This is how they go about building their wealth, the wealth creation effect. And that trickle-down effect that fell under Ronald Reagan, I don't think works anymore, because I've seen some charts where corporations make money, but the wage growth just isn't there. They've talked about it for about a year. There is no growth there. So the only real way to build that wealth is through this type of trading. I hate to say it, but you got automation coming about with robotics, so that's going to take out a lot of jobs. It just does not. The future, I don't want to sit here and be a Debbie Downer, but the future is going to be very challenging for a lot of folks. And the debt levels that are rising, actually I could probably pull up an article on that if you want to know what I mean. So if I look up household debt, this is as an example for Isaac correlations that you can use. Household debt to GDP. This is very important, okay? Even for my future. Okay, so as an example here, this one right here. Okay, so this news headline is really important for Canada. The Canadian debt for households has broken through 100. So what do I mean by that? Now again, the numbers don't lie. You usually won't hear about this in national mainstream news because they don't want people to panic, right? But I think these are very important facts. So when you look at the household debt, these are households. with low income, high levels of debt. So if you're in Toronto and you're carrying a mortgage of, let's say, $800,000 or $1 million mortgage, and your salary has not gone up in the last 20 years, how do you keep up with it? You can't. That's the problem. So when you start looking at things like this, household debt against the GDP, where let's say in Canada, right here, you can see it's 175. So that means that for that's disposable income, which is very low. And you can also measure that against GDP. And there's reports that will show the household debt against the GDP of the country. If it's over 100, you're in trouble. I think I've shown examples of the U.S. debt is around 89%. Canada's over 100. Australia's 120%. And that's why you start to see these news stories, as I said, about from the Australian central banker, that wage growth is really killing off a lot of households. It's because of the debt of the households. And then we have not even talked about government debt as well. As an example, the U.S. federal debt, $20 trillion plus dollars, and how will that government pay the piper? If they don't pay it off, or if they try not to show any efforts of it, the markets will take care of it. And what will happen is the markets will basically get spooked. And what that would mean is that the U.S. markets will lose confidence in the Fed. And once that happens, all bets are off in terms of growth or opportunity. And that's what really started the depression in 1929, is once the markets lost confidence. And when you start to see these numbers, it looks pretty scary. But the way I look at it, using this automated trading, looking for areas of growth, using the methodologies that I've looked at, you can do quite well. And you automate it and you scale it out, and you can do it by country. We're just right now focusing on the U.S. And again, we'll do this again in 2 weeks to see where the States is at. And this is why one of the big benefits of doing this sort of stuff of algorithmic and automated trading can really help to build out your so-called wealth for retirement, as I've hinted in that document I just mentioned here. This one I mentioned already. That's pretty well it. I've done enough blabbing for an hour. Anybody got any questions so far? Otherwise, I can close it out. Just type it up in the chat box or unmute yourself and just go ahead and talk. No are questions from Isaac. Well, thanks everybody for listening. Anybody got any questions? Okay, if that's not the case, I'll do a going once, twice, 3 times, and then we'll talk about next week. Going once, going twice, and going 3 times. Okay, no more questions then. Okay, so next week, same bat time, bat channel at 7 o'clock next Monday. What we're going to do is we're going to continue doing this story, but there's what's the word? Not illusion, a disillusion. My brain is so scatterbrained, it's scary. But the idea of what I'm going to do is talk about risk and looking at your portfolio and knowing how to segregate your portfolio out. Let's say if you have, I don't know, $100,000 and you want to get a return of, let's say, 1% every day, how do we deploy that capital and where do we put that capital, and what we call capital at risk when we put it out there for trading purposes or investment purposes so we can get back a return, and then how and where do we look for those maximum return opportunities as we did tonight through these reports, on top of the weightings of that capital. So if you have $100,000, you put $25 or 25% of it into gold because it looks good, and another 25% into oil because that looks good. So you have to worry about the weightings, and we'll talk about that next week as another example. Got a question. Yeah, hold on, Andrew. Okay, so what are the examples of auto traders that would allow to capture 1%? Are these available? Yeah, as I said, they're always available. You just got to know where to look, either in Forex or options. As I said, I've talked about the moves with the US dollar. With interest rates is a big one. If you know that the interest rate's going to go up or down, that's going to be most likely a bigger 1% move. as an example, with the UK election that happened, I think the British pound fell 2 or 3% within hours of the announcement. So if you know those kind of calls, or I mean, if you want to, the gambling type, and you're willing to take those kind of bets, you can put on a short among different positions or different currencies, like across 6 different assets or trading pairs, and then have 6 trading opportunities. A good example of that is when the Swiss National Bank in 2015, in February, I believe, or maybe it was 2014, but they depegged from the euro, and the markets went crazy that and at night, and there was like 20% moves throughout about 6 different currencies, and people made a lot of money if they were on the right side of that trade. Um, and also about commodities and forex. I have a course on that distinguishes between opportunities and futures and options. But I'll tell you, 80% of the opportunity and options, or out of the two, 80% of the opportunities and options. It's not a hard. It's a hard asset to trade, asset class, but there's a lot of data that you can use to get the right forecast, especially in the world of commodities um, as well. And I'm not sure if I've answered that question, but those opportunities are there. But I've got a course on that, and there's the traditional ways of what traders look for. If you want my piece of advice, always look at the Bloomberg News app and look for those trading patterns, especially for futures and options. And you read it every day for, let's say, 6 months. You'll see those patterns to get these 1% moves. And I've been doing it now for a year, and it's been pretty consistent. And you can also find those in the world of options and forex. Um, Let me also mention, if you use your broker, I've got a video where if I use Duca's Copy, my Forex broker, they have a news event calendar, and there every day there's news events by country. Maybe this country may announce their housing starts like the U.S. did on Friday, um, and you can forecast off those type of events on a calendar basis, and you can get 30, 40 of them a day, and you can build trading strategies around that and look for data that will give you a better probability on that call and build trading strategies around that. That's very possible, and that's something I'm definitely wanting to do. That's for forex, but you can also do the same thing for options, specifically around commodities. That's why I'm not a big fan of stocks, because it's still kind of unpredictable and there's a lot of room there for manipulation. But because you're dealing with Forex, which is $4 trillion a day, I mean, it's pretty hard to manipulate that. Also, with commodities, the same, because the volumes are just so big, it's pretty tough to manipulate unless they get together and do some kind of some of the secretive things that they've done over the years. Um, so Isaac says there was a online trading academy guy made 65 grand that day. Now I'm not sure if they're referring to the Swiss National Bank. I'll give you an example. Yes. Okay. Yeah. I've got guys with those 20% moves, 6 positions on. You can make some mad money in these events. I'll give you an example. I got an alert from somebody in 2014. I think it was 2014 for oil, short oil, short oil. Over 3 months, this guy made about, I think it was 600,000 euros in 3 months. So there, when you get these calls right and you're willing to put some big capital on, you can do really, really well, especially with the maximum returns you can get, specifically around forex as an example, in options, and you can do really well. Just depends upon the risk you're willing to put on, the amount of capital you're willing to put on, and if you get that call right, you can do well. But again, on the other hand, you can lose too. That's why you need this data. And when you have the data that I've shown for the Fed Reserve as just one example, it raises your confidence quite a bit. Because one of the reasons why I don't trade as much as I want is because if I'm trading as a human and basing it on intuition, I'm going to get I'm going to get a lot of health problems, basically. But if you have the data to use for confidence, you can do really well. And that's what we're doing here, is building that data, building out the charts, and building out trading scripts to use for trading signals. And that's where we're going. Um, Anybody else got any comments or questions? Because this is the whole point. I mean, I could ramble on all day, all night about it, but what do you guys say? Anybody? As I said, next week we're going to focus on portfolio management. Risk management is part of that as well. Traditional traders, the real good traders, spend about 80% of the time doing next week's stuff, and they do very little trading, 20%. And then there's the day trading mode, which has happened between the U.S. election and now with the Trump election, because it's been an upward momentum swing. Anybody else got any questions or concerns? So hopefully we'll see you next week. I do believe I put up the link on the Facebook, the meetups, my blog. So if you need it, let me know. And if you need to reach me, hopefully you guys know about the Facebook groups. The best way to reach me out is on that, or tweeting, but nobody really uses it. Anybody else got any questions? If not, we can give it a wrap. So we'll do another going once, twice, three times. And if not, we'll close it out and we'll do all next week all over again. No problem, Isaac. Anybody else? Okay, going once, going twice, going three times. Thanks, Ron. Thanks, Isaac. And we'll see you guys next week, okay? And happy trading. And if you want, you can join my quantitative analytics stuff next week. Okay, talk to you guys next week. Later.